Retail traders routinely buy into visually perfect chart breakouts, only to watch the market immediately reverse against them. They assume they had bad luck, but the trap was set specifically for their order flow. Standard technical analysis, moving average crossovers, subjective wave counts, and geometric trend lines relies on lagging price history. High-frequency trading algorithms actively monitor these predictable retail signals and use them to engineer liquidity. Look at this comparison. On the left is visual pattern recognition, guessing where price might go based on historical shapes. On the right is tape physics. This relies on the direct measurement of live order book velocity, timeframe synchronization, and volume compression. To stop acting as liquidity for institutional algorithms, we have to construct an execution matrix from first principles. We will strip away the price action layer to expose the mechanical structure of the tape. We are going to build this architecture in 4 distinct phases: establishing macrogravity, mapping tactical cash boundaries, measuring momentum fuel, and finally, isolating the execution trigger. Standard technical analysis forces traders to trade the smoke. True algorithmic execution requires measuring the fire of the underlying tape physics. We begin with the multi-time frame mean. Moving averages are misunderstood as static support lines. In tape physics, they function as dynamic velocity anchors, measuring friction between temporal participants in the market. This 5-minute chart tracks that friction. We project higher timeframe anchors, 15-minute, 30-minute, hourly, and daily averages, onto a short-term grid. When synchronized, they form a pristine stack. Velocity expands. Algorithms pull in the same direction, making fading the trend mathematically improbable. But timeframes do not stay synchronized. When the gears clash, the lines twist into a chaotic knot. Price action slices back and forth through the center. This is the mixed blender state. The mixed blender represents a specific institutional action: inventory rebalancing. Fast money algorithms drive price down, while daily macro desks quietly accumulate the floor. Momentum strategies fail here because net directional momentum is completely absent. The rule for navigating desynchronization is avoidance. You stay in cash, preserving your capital, and wait for the matrix to uncoil. Relying on a single time frame ignores the multi-layered mechanics of the tape. Attempting to fade a pristine stack or navigate a mixed blender results in frequent structural failure. Moving from macrogravity to intraday tactics, we must discard the retail initial balance. Algorithms actively use the absolute highs and lows of the first hour of trading as bait to capture breakout buyers. This geometric overlay is the 20-40-50 tactical grid. By ignoring extreme wicks and dividing the active session range into precise internal quartiles, we locate where institutional cash settlement takes shape. The 50% midline serves as the absolute session equilibrium, filtering intraday macro bias. Trading above it signifies a structural bullish bias. Below it, the bears control the floor. Look at the 40% edge lines. These are dense walls of resting limit orders. Large institutions accumulate and distribute assets inside these boundaries, aggressively defending their positions at the 40% mark. Identifying these boundaries dictates the mechanics of position sizing. Professional risk management must be dynamically pre-engineered before an order ever reaches the book. We calculate this using a strict equation: live volatility range multiplied by 40%. During massive volatility, the numerical risk unit expands, requiring a scale down in contract sizing. When range compresses, the risk unit shrinks, allowing heavier contract leverage with identical dollar exposure. Market support is not found at the extreme wicks of a single candle. It exists inside the mathematical cash block where institutional capital settles and risk is pre-calculated. Once the geometric price map is established, we shift to the underlying momentum fuel gauge. We track the chronological life cycle of volume across 3 distinct phases. First is the A wave. This is the initial aggressive market order drive. It represents the primary intent to move an asset out of its current balance. Second is the B wave. This marks the necessary consolidation phase. As price stalls, retail traders place tight stop losses just past the immediate local highs and lows. This chart details the liquidity sweep. Algorithms push price below a structural floor, forcing retail stop losses to execute and creating panic selling. Institutions absorb that liquidity at a discount. Selling pressure vanishes, triggering a bullish reclaim back across the boundary.
Finally, we monitor the C wave, tracking cumulative volume delta to reveal passive absorption. Look at this divergence. Price prints a lower low, but the volume delta histogram beneath it prints a higher low. This structural divergence proves that passive iceberg limit orders are absorbing the sell-side pressure. The downward momentum has been hollowed out from the inside. Price action frequently lies to generate liquidity. Only the direct measurement of volume delta can reveal when an apparent market crash is actually an orchestrated institutional accumulation trap. The final layer of the architecture exists entirely outside of price. Institutional algorithms execute on strict time-allocated liquidity cycles. Watch the 09:45 a.m. power bar lock. The first 15 minutes generate chaotic imbalances. At 09:45, algorithms evaluate Veuetra continuation or reversal. At 10:20 a.m., the Judas trap executes, an engineered fake breakout deployed to capture retail liquidity. At 11:40 a.m., the tape enters the London close vacuum. European institutional desks withdraw liquidity to rebalance their books, causing morning trends to suffer sudden stalls. Finally, the 15:40 p.m. power hour imbalance squeeze arrives. Concentrated market on-close requirements force portfolio managers to adjust their exposure, resulting in a vertical covering rally. Trading without synchronizing to the algorithmic clock turns sound technical setups into accidental liquidity for time-based institutional rebalancing. An algorithmic momentum signal firing in open air lacks an institutional anchor, but against a heavily defended structural boundary, the reaction is immediate and explosive. We define this exact mathematical coordinate as the nuclear junction. It is the precise microsecond where macrogravity, cash settlement walls, and momentum exhaustion simultaneously collide. To execute, we apply a binary checklist. First, multi-timeframe curves lock in macrogravity. Second, price rests on the 40% cash boundary. Third, histograms confirm fuel exhaustion. Finally, a directional arrow mathematically authorizes execution, replacing subjective discretion with binary tape mechanics. But survival in quantitative trading requires one final protocol: unconditional structural invalidation. If a candle closes below that 40% wall or violates the pre-calculated risk unit, the institutional cash settlement has structurally failed. The institutional buyers have abandoned the line. In this matrix, stop losses are mathematical realities of changed states. They are not arbitrary pain thresholds to be adjusted out of hope. When the structure fails, the position is immediately liquidated. Professional execution is an emotionless architecture of physics. Map the macrogravity, calculate the upfront risk, read the volume absorption, and only pull the trigger when the matrix forms a nuclear junction.